Hi students, Professor Orenberg here, and welcome to our series on organizational choices. This will be a series of videos covering which type of business association to form and why. And we're going to break this apart into a series of smaller videos to make it a little easier to remember all of the details that are involved in the study of business associations' organizational choices. So let's get started. This series is going to proceed with 6 videos. First, we're going to introduce the process of selecting a business entity by reviewing 7 issues that are going to come up time and time again when deciding what entity to choose. We're then going to discuss the 4 major types of organizational choices: general partnerships, limited partnerships, C corporations, and limited liability companies in the context of those 7 issues, forming a matrix of effectively 4 entity choices by 7 issues. And then in our 6th video, we're going to summarize everything by briefly noting some alternative organizational choices that can be used for professional groups, and then summarizing the 7 issues across this matrix of 4 types of organizational choices. And in that process, you will learn the differences between the 4 major organizational choices and when to select one or the other for basic business planning purposes. In the previous 4 videos, we went over our key organizational choices that are going to be our most common, being the general partnership, or GP, which is the simplest to form. There's no filing required, but it does have not only unlimited liability for the partners, but joint and several liability for the partners who have taken acts on behalf of the partnership. So while simple and cheap to form, it has its costs on the back end. The limited partnership has limited use. It really is designed as an investment vehicle. It does have limited liability for its limited partners, unlimited liability for the general partners. The way around that is a blocker corporation or a C corporation is going to be the general partner, and that's going to avoid liability for any persons in the institution, but it's relatively expensive to form and only necessary if you really need a traditional a way to approach an investment fund. We then looked at the C corporation, very popular in America for business of going concerns, where you have to organize a lot of capital and labor. It has the benefit of separating ownership and control, so we can transfer ownership rights more easily without worrying about that creating any liabilities or control issues. Corporations are somewhat flexible, but they are designed to be hierarchical, so if you're looking for something else, you may select a LLC, or limited liability company. An LLC is the most flexible, and they can be designed either as member-managed or manager-managed. A member-managed limited liability company is going to function like a partnership, and a manager-managed limited liability company will function like a corporation, giving you some options and flexibility as to what type of entity you want to create. The LLC, being the most flexible, also gives the most room for error and is the newest, so there's the most uncertainty. But that said, still a lot of advantages to using that form choice. In addition to the basic forms, there may be a need to form a more specialized form. So, for example, we have the limited liability partnership, which are for professional groups. Professionals may not be allowed to limit their malpractice liability. For example, the state bar associations require lawyers to form limited liability or professional corporation entities because those entities signal to the world that the operators of it remain liable for professional malpractice. And so the professional corporation and the limited liability partnership are both forms that are popular. Also, sometimes we see doctors' offices formed as a professional association, which is a useful form because of their liability structure. And so those are going to be our major forms for professional groups that, for whatever reason, in the jurisdiction that they are located, cannot form a fully insulated anti-liability vehicle like an LLC, because that need to maintain liability for malpractice. As I mentioned previously, limited partnerships have typically been used for investment groups, and they are a classic form of investment vehicle. In addition, there was, for a brief time, the use of LLPs, limited liability, limited partnerships. Those have effectively gone nowhere and are virtually irrelevant today because they were relatively complicated, not recognized, and available in all states, and have been mostly surpassed by the LLC. So not a particularly useful form in today's business. The LP is still used maybe out of habit, out of security, and doing sort of what's done before as to avoid liability for doing something new. But once again, the LLC can fulfill that role as well. I should also mention, of course, there is a sole proprietorship. Here we're talking about business organizations which involve two or more people. The definition of sole proprietorship is having one person who owns all the assets, all the liabilities, and operates in his or her personal capacity. So it's not an association, meaning it's only one individual who's simply operating a business. Has unlimited liability for that individual. The business is basically an extension of themselves, and as a result is not really an association of any type, but rather what we call it when a person who is doing business in their individual capacity runs that business. We treat that as a sole prop or sole proprietorship, but doesn't require any formation and doesn't provide any protections. So it's quite risky for that proprietor, because now any business activity could result in personal liability. And once again, the LLP is the common form for a law office. Yes, you can form a law office with a professional corporation. Yes, in many states you could use an LLC. Some states even permit a corporation. But something about the LLP title sort of announces law firm, and it remains popular for that reason. Let's briefly review our chart and go over the details on our matrix of our 7 issues and our 4 common entity choices to see which type of entity we should choose. So in terms of the issues that came up, we looked at the costs and challenges associated with formation, what liabilities would be incurred by the owners and operators, who will control the company, who enjoys the financial rights to the company, does the company live forever, or can it be dissolved by an action of any one person or multiple people? Can an individual sell their shares and transfer their rights, and how can the company merge or assimilate with others? Going down our list, the general partnership is the easiest to form. It just requires association. It is recommended, of course, to have a partnership agreement. The risks of the partnership is that it can be formed, of course, by default, and so that's the issue to watch out for, is the inadvertent partnership issue. The reason that matters is that will result in joint and several liability for the partners for all the actions taken on behalf of the partnership, and so that can be a big liability issue for your clients. The default is one partner, one vote, so the control rights are equal, as are the profits and losses. The continuity depends on whether you're in an older, and there are only a few UPA jurisdictions, or in a newer RUPA jurisdiction. The newer jurisdictions do not take the entity approach. They take what's called they take an entity approach. They don't take the aggregate approach. And under the entity approach, the entity, the general partnership is its own entity, is separate, and it can continue even with the withdrawal of one member or more. Under the Uniform Partnership Act, which took the aggregate approach, any withdrawal resulted in the end of the business. In general, you pick your partners carefully, and unsurprisingly, control rights are not transferable. One's rights to profits tend to be transferable. And mergers are simple. They can be made by agreement. Moving to the limited partnership, cannot be formed inadvertently, requires a formation certificate of formation to be filed. The result of this is an entity with limited liability for limited partners, hence the term limited partners. They can only lose what they invested, but the general partners maintain unlimited liability, and so sometimes we substitute a blocker corporation for the GP and have a person sit behind the corporation, so there's no personal liability, really. The control rights, the GP is designed to control everything. The limited partners are simply dumb money who invest and sit back. The distributions are shared pro rata based on what was invested. It will also be governed by the operating agreement, the partnership agreement, which will almost certainly include some additional management fee for the general partner, sometimes called the cash and carry. The continuity of a limited partnership is that if the GP withdraws from the business, that can dissolve the partnership. In an older state. In a newer state, it has to be all the GPs withdrawing, but the limited partners cannot themselves cause the partnership to be dissolved. And the control rights, once again, are not transferable. You choose your partners at your peril, so you want to choose them carefully. The financial rights are transferable, and the merger, like the formation, is done upon agreement. A C corporation, meaning a tax-paying corporation, a corporation that's seen by the IRS as its own tax entity, is also formed by incorporation, by filing of a certificate. It's governed by bylaws, which are critical documents explaining how the company will be run. An advantage to a corporation is every shareholder, every owner gets limited liability, although they are set up in a hierarchical control structure. The directors are going to control the company. They're going to do that by voting on extraordinary matters and appointing officers for the day-to-day matters. The shareholders' limited control is to vote for the directors at the annual meeting. The financial rights will be distributed pro rata when and if a distribution is ordered by the directors. The shareholders cannot demand a distribution of profits. Corporations generally are meant to last forever. They're meant to operate business as a going concern. The shares are freely transferable, at least in theory, at least as a matter of corporate law, but as a matter of practice, there are a number of transfer restrictions, both privately and publicly, that are placed upon corporate shares. The merger is a little bit more complicated because it does require not just board approval, but also shareholder approval and a filing with the government, requiring a little bit more time and effort with mergers, of course, M&A being the subject of an entire course. And then finally, we get to limited liability companies, which are created upon the formation of a certificate of formation, which is going to be filed with the Secretary of State. Critically, these are governed by the LLC agreement, although a private agreement is going to define the rights between all the parties, so it's an essential document. The members of the LLC have limited liability, so they're not going to be out more than they have invested unless we have an issue involving piercing the limited liability company veil. Control rights vary depending on how we structured it. We can structure it, an LLC like a member-managed LLC is going to function like a partnership, so the members are going to run the business like the partners would run the business, and so there is no separation of ownership and control. Or we can organize it like a manager-managed business where the managers are separate from the owners. Could be the same as the owners, but could also be private managers who sit in a board of managers, and those are going to function like a corporation. Manager-managed LLCs, like having a board of directors, would have a board of managers. The financial rights will generally be equal distributions, but once again, it will be governed by the operating agreement, so please consult the operating agreement. The continuity of an LLC is perpetual. It should go on forever. And what's interesting, according to Sean Barron, a professor at Florida State, is this is true even if all the members withdraw, which is very interesting to think of a zero-member LLC that is still able to continue operating. The LLC units are generally freely transferable. However, there are a variety of ways that those can be hung up in terms of transfer restrictions, just like corporate shares. And once again, a merger is going to require approval by the members of the board of managers and the members as well in that case, and a filing. And as a result, it does require some paper and process. Now that you've gotten to know the basic entity choices, let's take a look at a couple common use cases and see if we can determine when we would apply which business organization. So check that out next.